Lenders look at several factors when weighing their risk. We learned about the 3 C's, creditworthiness, collateral, and capacity, and now we'll dig a little deeper into the supplemental factors. The level of loan documentation a lender will require is based on the strength of the 3 C's. A strong example would be a purchase of a single-family residence, owner-occupied, a conventional loan with 30% down payment, credit scores above 760, and 12 months of cash reserves. A scenario like this may require less documentation by Fannie Mae and Freddie Mac's automated system. Instead of 2 years of W-2s, they may only require 1. If self-employed, they may only require 1 year of tax returns instead of 2. And it's possible that only 1 month of bank statements will be required versus 2. Let's break down the supplemental factors for the lender.
First is occupancy type. Owner-occupied is a low risk for lenders. A second home is a moderate risk, and non-owner occupied investment property is a high risk for lenders. Secondly is property type. Property types and risk were covered in detail in the collateral video. Third is the property common for the area. Unique home styles like dome homes or log homes can be very difficult to finance because of the lack of comparable sales of like properties. These style of homes can be a high risk for the lender. Homes with in-law units or guest houses are mostly a moderate risk for the lender. If the property is not properly zoned, you can remedy this with an appraisal showing 3 comparable sales of like properties with a guest unit. If the property is properly zoned, only 1 comparable sale with a guest unit is required on the appraisal. Manufactured homes pose a high risk for the lender. Remedy this with an appraisal showing 3 comparable sales of like properties, all meeting the real property standards outlined in the collateral video. Fourth is employment history. Over 2 years in the same job is considered low risk. Over 3 job changes in the last 2 years is a moderate risk. Over a 60-day employment gap in the recent 2 years is a high risk. This can be remedied with a 6 months of continued employment in the same line of work preceding the application for mortgage qualification. Self-employed under 2 years is a high risk. Not allowed in most cases except with an automated approval similar to the example that I gave at the beginning of this video. Change in line of work in the recent 2 years is a high risk. Remedy with 1 full year of continued employment in the same line of work. If you have less than 1 year working in your field of study after college, lenders will allow your years of study and months on the job to be combined with a stable W-2 income if you can prove that it's in the same line of work. This is considered a low risk. 5 is down payment and source. We have savings and checking accounts. It can be investment accounts, savings bonds, trust funds, a family gift, a sale of personal property, a down payment assistance program, an IRA or 401k distribution or loan.
The AU system layers the risk of the 3 C's and the supplemental factors to approve or deny the loan and determine the lender's risk. In some cases, a loan may be approved by the AU system but denied by the underwriter upon review of the borrower's documentation. Also, some lenders have additional criteria called overlays on top of the investor's underwriting guidelines that could potentially make it harder for someone to qualify. But by following our roadmap to buying a home, you can avoid most pitfalls. Lenders also use the 3 C's and the supplemental factors to price out interest rates and offset their risk. If getting the lowest interest rate is important to you, understanding these factors can help you get prepared. Also, I don't advise comparing your interest rate with others because you'll have no way of knowing all of their factors and what market conditions were on the day they locked their rate. You see, the bond market changes daily and sometimes hourly and plays a big role in the interest rate as well. Your loan officer will have a pulse on the market conditions combined with the length of your escrow to determine the lock period needed. This is also why you can't trust interest rates quoted on the internet. How could they be accurate interest rates without knowing your down payment, credit score, property use, and what type of property you're purchasing? If you're shopping your loan, do it on the same day and factor in the bond market movement during the day with your loan officer so you can compare apples to apples. I'll cover loan documentation in more detail in the pre-approval versus pre-qualification video. And that covers supplemental factors and interest rates.
Thank you for watching, and here's how you can help us. First, share us with your network on Facebook, Instagram, Twitter, and YouTube. Secondly, tell your family, friends, and coworkers about us. And lastly, we are publicly funded and need your help keeping our videos free by clicking on the Support tab today. Don't miss the tips and timing video, found only on our website, for all the ways that you can save hundreds of dollars when buying a home.